Hi, thanks for joining us today for our video update. And my team and I are always striving to keep our clients and prospective clients updated on what's going on with the market, and when we see timely information that we feel is worth sharing. So we're trying some new technology. We're going to do these video updates, and we'll be striving to improve them as well. But I came across a great piece of information from the American funds, this brochure, which is titled The Guide to Market Recoveries. And so we're going to go through that brochure. We'll also email you an attachment of the folder or of the brochure so that you can follow along in more detail if the slides are a little too small in this presentation. We'll also post this on the website for future review as well. But as we see things from time to time that we feel are worth sharing, we'll send you links or post these on our websites. And on the first page, as you open it up, as the fund company points out, this is put together by American Funds. It's one fund family that we do like. We like many companies, but they also have really good material I think is worth sharing. And the first page is titled Recoveries Don't Feel Good, which is true. As you're going through recoveries, a lot of times we don't think it's happening, and that is a lot like right now. And if you look at the chart here on this page, it goes back to the first correction in this illustration was from January of '73 till October of 1974. For those of you who are around back then, you might remember, I was in middle school and starting high school when there was the oil embargo, Watergate, and then Nixon resigned. The U.S. markets were down about 48% during that time period. And then after that we had a real slow recovery, which is a lot like right now. The current situation today is very similar to the mid and late 1970s. And as you follow along on the chart here, you can see in 1975 the unemployment rate was at 9%. And now, does that number sound familiar? It's about where we were at last year, and things are starting to recover a little bit right now. Also then in 1976, New York City threatened bankruptcy. Another familiar theme. 1977, we were going through an energy crisis. Massacres in Cambodia in 1978, and then a 3 Mile Island nuclear accident was in 1979, which is kind of uncanny, some of the same situations we're going through today. Yet after that 50% downturn, which is similar to the one we recently went through, from October of '07 till March of '09, the U.S. markets were down almost 58%. Now since that time we've been recovering, but it doesn't feel like a recovery. Same thing as the 1970s, and through all those problems during the 1970s, the market averaged 17.39% per year for the next 5 years after the downturn. And we see similar gains over the last 2 years. Then, and then also another point worth mentioning on this illustration is that the unemployment rate was 9% in 1975. It took all the way till 1979 for the unemployment rate to go down to 6%. So when we look at right now, corporate earnings are good and strong, and companies are in good shape, but the unemployment rate is stubborn, and it's slowly coming down. In the 70s, it took about 5 years for it to get down. So if we use history as a guideline, it could be another 4 years before we get unemployment where we want it to be. Now the downside of that also, once the unemployment rate came down, if you remember the late 70s and early 80s, and we were deficit spending a lot like right now, then after Nixon, Ford was in, then Carter was elected looking for some change, and then we had double-digit inflation. Inflation reached 13% in 1979 as the unemployment rate came down and we had large deficits. So a lot of similarities in the 1970s. The next page in the 1980s, we had in 1987, the market dropped about 33%. Now this was a quicker recovery, but same kind of scenario through different problems. Bank failures peaking in '88, the Exxon Valdez oil spill, Iraq invading Kuwait, we were in a recession. Same thing, the market the next 5 years averaged just short of 18%. So you can see a trend there. If we go to the next page here, this takes a look at all the downturns since 1929. And since 1929, of all the downturns, 5 years later, 100% of the time, the market was positive. And your money doubled 12 out of 16 5-year periods after big downturns. And we look at all those big downturns, the best return following the 1929 to 32, the market averaged almost 36% a year for the next 5 years. The worst was just short of 10%. The average was about 18.95% per year for the 5 years following a big downturn, just like we went through from '07 till '09. So you can see a pattern there. On the next page, it takes a look at all the downturns since 29 to 32, and it shows following a big downturn like we had, the market average 18.95, but over the long run, the market average during that time period was just short of 9%. So we've just been through a big downturn. The returns historically have been quite good for the next 5 years. And right now we're 2 years into the recovery. The next page talks about companies and how they've been a driving force in the recoveries, because a lot of times, all the news out there is negative today and you don't hear any good news. But one good piece of news is that corporate earnings for 2010 came in nice and strong, because U.S. corporations acted quickly. When the downturn first started, they took action. Companies, as many of you know, they downsized their workforces, which wasn't nice, but it had to be done. They eliminated unprofitable work practices, sold off inventory, paid down debt. In short, corporate America really tightened the belt. And our productivity levels today are amongst the highest levels since World War II. So now, in short, corporate America is lean and mean right now. And not only are they lean and productive, as sales have improved a little bit from their anemic levels right now, corporate America is sitting on approximately $2 trillion of cash right now. And so companies are in great shape, they're productive, and they have a lot of cash on their balance sheets. This is all good news. Just the unemployment rate is stubborn, and we have the government out there deficit spending that we have to watch out for. On the next page here, and so also then many corporations were founded during tough times. Back in the 1970s, during that downturn, the cover of Time magazine said capitalism was dead, that we were going to lose to the Soviets and we were going to lose the Cold War and capitalism wasn't going to make it. But those same years, Microsoft and Apple Computer were founded in 1975 and 1976. And so if we look today compared to where we were 10 years ago on the next page, this is very compelling. Compared to 10 years ago, today corporations right now have 400% more cash on their balance sheets than they did 10 years ago. That would be like in your personal situation, you having 400% more in your own bank account. Okay, then as far as corporate profits go, corporate profits today are double or 200% where they were 10 years ago. That would be like you having your paycheck double. And then dividend payouts today are 40% higher than they were 10 years ago. So that would be like if you had a rental home or income, your dividends were up 40%. So I would say today there's a strong case that things are much better than they were 10 years ago. The next couple pages are pretty decent pages, but those are more of a commercial for American funds, which, as I mentioned, is one fund company that we do like. We like many different ones. If we switch over to the next couple pages, it hits on the point of staying the course. And I know almost all of you have stuck with the course. You've been dollar cost averaging, and look at these downturns as a period of opportunity. This last 10 years have been very difficult. This has been the chance, a buying opportunity of a lifetime, to be buying during these tough times. And as we look back 10 years from now, people will probably be saying, I wish I really would have been buying back then during the downturns, and to use these declines as a opportunity. So I just wanted to share some good news, and this is a piece that I thought was worthwhile. So please take a look at it and give us a call if you have any questions. Thanks.